$84.20. That's where silver is trading right now, today, March 6th, 2026. And if you looked at that number in isolation, you might think, okay, not bad. But here's what nobody's putting together for you. Just 30 days ago, this exact metal hit $121.62 per ounce. That's a 31% collapse in less than a month. And now it's bouncing back from the 80s toward that same $84 level, while the COMEX exchange, the place that's supposed to guarantee the price of silver to the entire world, is sitting on registered inventory that covers barely 60% of what people are demanding to take physical delivery of right now. Let me repeat that. The exchange that sets the price of silver is facing delivery demands for 52.63 million ounces of metal against a registered inventory of just 86 million ounces. And that inventory has already dropped 31% since October. Something is deeply wrong with this picture, and by the end of this video, you're going to understand exactly why this divergence between the paper price and the physical reality may be the most important financial story of 2026. Let's talk about what just happened, because the speed of this has been historic even by precious metals standards. Silver started 2025 around $30 an ounce. It doubled, then it doubled again. By late January 2026, it hit an all-time record of $121.62. $121.62. And then on January 29, 2026, in what the Wall Street Journal described as the largest one-day drop in modern COMEX history, silver shed nearly 30% in a matter of hours. The catalyst? CME Group, the world's leading derivatives exchange, announced it was raising margin requirements on silver futures for the third time since January 13th. 3 margin hikes in 23 days. They pushed the requirement from 15% to 18%. That sounds modest, right? 3 percentage points. But here's what it actually means. Every trader holding a single 5,000-ounce COMEX silver futures contract suddenly had to post an additional $7,500 in cash immediately, or get liquidated. Multiply that across tens of thousands of contracts, and you get a cascade. A waterfall of forced selling that had nothing to do with supply, nothing to do with demand, and everything to do with the mechanics of a leveraged paper market. By February 3rd, silver was sitting in the mid-70s. The white metal had given back almost all of its stunning 2025-2026 rally in the blink of an eye. That is the CME volatility story. But it's only half of the story. Now I want to establish something important before we go any further, because I know some of you are new here. I'm not going to ask you to trust me on any of this. Everything I'm about to show you is documented in official exchange reports, government filings, and verified financial data that you can pull up yourself. The COMEX delivery reports are public. The CME margin notices are public. The Federal Reserve statements are public. What I'm doing is connecting dots that most financial media is too conflicted, or too lazy, to connect for you. So let's go to the data. Quick message to those watching who haven't subscribed yet. My analytics show about 3 out of 4 of you right now aren't subscribed. If this kind of unfiltered, number-by-number analysis is cutting through the noise for you, hit that subscribe button. It's free. It tells me the committed community is here, and it helps the algorithm show this to more people who genuinely need to see it. Now, the jobs data, because this is where it gets deeply interesting, and it connects directly to that $84 silver price you're watching right now. On February 11th, 2026, the delayed U.S. January jobs report finally dropped, and the numbers were stronger than expected. The labor market came in firm. Here's what the financial media told you. A strong jobs report means the Federal Reserve won't cut rates. No rate cuts means a stronger dollar. A stronger dollar means lower gold and silver prices. That's the playbook. That's the story they ran. And silver dropped more than 10% that day, falling from $84 to $74.95 in a single session. CNBC reported it. Bloomberg reported it. Everyone reported the same thing. Strong jobs, dollar up, silver down. Simple, clean, logical. Except it wasn't simple. It wasn't clean. And it wasn't fully logical, because here's what happened simultaneously. Delivery demand on COMEX silver contracts didn't slow down. Industrial users didn't say, oh, the jobs report is strong. I guess I won't need silver for my solar panels this month. Samsung didn't cancel its direct offtake agreements with silver miners. Tesla didn't renegotiate its supply contracts. The physical demand continued at exactly the same pace, even as the paper price was being hammered down by algorithmic traders reacting to a single data point. And that's the disconnect I need you to sit with. The The paper price went down, the physical demand went up. One of those things is telling you the truth about silver's value right now. Let's go back and understand how we got here, because this exact pattern has played out before. Not once, not twice, 3 times in modern history. And each time the paper market said one thing while the physical market said another. And each time, eventually, the physical market won. In 1973, commodity markets were telling traders that oil was abundant and prices were under control. Meanwhile, physical buyers in the Middle East and Europe were telling a completely different story. The paper market was wrong by approximately 400%. That's how much oil prices moved when physical reality finally asserted itself. In 1979 and 1980, the Hunt brothers accumulated physical silver. The paper market was still pricing silver around $8 an ounce based on historical futures positions. The physical market said that was wrong. Silver ran to nearly $50 before the COMEX, sound familiar? Changed the rules. They raised margin requirements dramatically and restricted new long positions. The paper price collapsed. But here's the thing. The Hunt brothers weren't wrong about the fundamentals. They were right. They were just defeated by regulatory intervention in the paper market. And in 2021, a Reddit community tried to squeeze the silver market. They sent silver from around $25 briefly toward $30. Then the paper market pushed it back. But the COMEX registered inventory never recovered. Look at the data. In April 2020, COMEX registered silver inventory was 240 million ounces. Today, it's 86 million ounces. That's a 64% decline over 6 years. The squeeze attempts failed to crash the paper market, but they bled the physical inventory relentlessly. And now, we are at the point where that 64% inventory decline is colliding with a delivery demand that's 7 to 10 times higher than historical averages for January and March. That's not a coincidence. That's a slow-motion reckoning that's been building for years. Let me show you the specific numbers that explain why March 2026 may be remembered as a turning point. On the first notice day for the COMEX March silver contract, that was February 26, 2026, 10,526 contracts stood for physical delivery. Each contract represents 5,000 ounces. Do the math. That's 52.63 million ounces of silver that traders are demanding to take physical possession of. Now remember that registered inventory, the inventory that is actually available for COMEX delivery, is 86.13 million ounces. So silver standing for delivery in March represents 61.1% of all available registered inventory. That's the delivery pressure ratio. Now compare that to normal. Historically, delivery demand for a major COMEX month typically represents somewhere between 10 and 20% of registered inventory. We are currently at over 60%. And here's the brutal detail that nobody's talking about. On the very first day of the delivery window, 4,540 contracts were immediately delivered. That's 43.1% of the standing contracts fulfilled on day one. Compare that to February 2026, when the first notice day saw 1,881 contracts. The February spike itself was already the highest in modern history. March's first day deliveries were a 141% increase over February's record. These are not speculators rolling paper positions. These are industrial users, electronics manufacturers, solar panel producers, electric vehicle battery makers, taking bars of real silver into their own custody because they don't trust that the metal will be there when they need it later. And let me tell you why they're right to be worried. In January 2026 alone, this is not a major delivery month, remember, March is the big one. COMEX processed delivery of 33 to 40 million ounces of silver in the first 2 weeks. That's 26% of the entire registered inventory that drained in 14 days. For historical context, in a typical January before 2026, COMEX silver deliveries totaled between 1 and 5 million ounces for the entire month. What happened in January 2026 was a 7 to 10 times increase over historical norms. Something broke in January. The delivery data tells you exactly what it was. The silver market shifted from being a financial instrument traded by speculators to a physical commodity being hoarded by industrial users who can see the supply chain tightening from the inside. And then there's China. Because you cannot understand the current silver market without understanding what China did on January 1st, 2026. That was the date China implemented strict export controls on refined silver, effectively classifying it as a strategic material. One analyst described it perfectly. China severed the traditional arbitrage routes that had previously allowed silver to flow between the Shanghai Futures Exchange and COMEX. Before those controls, when COMEX inventory got tight, traders could source silver from Shanghai. That valve is now closed. And look at the Shanghai premium data. As of March 3, 2026, Shanghai silver was trading at a $9.38 premium, a 12% spread over COMEX prices. That spread shouldn't exist in a functional, integrated global market. That spread is the market telling you that the two pricing systems are no longer connected. The paper price in New York and the physical price in Shanghai are diverging. Which one reflects reality? The one where real industrial users in the world's largest manufacturing economy are paying 12% more than the paper market says they should have to. Now let's bring the Fed back into this picture, because the jobs data story is more complicated and more troubling than the headline suggested. Here's what the Federal Reserve's own statement from January 28, 2026 said. I'm not paraphrasing. The official FOMC statement acknowledged that job gains have remained low, while noting that inflation remains somewhat elevated. Two FOMC members, Stephen Moran and Christopher Waller, actually voted to cut rates at that meeting. The full committee voted to hold at 3.5% to 3.75%. Now here's the critical context. The strong February jobs report that supposedly crushed silver on February 11th, it reduced the probability of a March rate cut to less than 15%. That's according to CME FedWatch data. Markets shifted to expecting 2 quarter-point cuts later in the year, June and September. Meanwhile, UBS's Global Wealth Management Chief Investment Officer stated publicly that easing inflation and moderating growth in the coming months will gradually take priority in the Fed's decision process. 2 rate cuts are already priced in for 2026, and David Einhorn at Greenlight Capital said publicly, on February 11th, the same day silver was getting hammered, that the Fed will cut substantially more than the 2 cuts that are priced in. He's so confident in that view that he's building a major gold and silver position around it. So you have a situation where the paper market used the jobs report as an excuse to push silver down 10% in a day, while the macro backdrop actually remains fundamentally supportive for hard assets. The jobs data wasn't a game changer, it was noise. And institutional buyers who understand that are using the paper sell-off to acquire physical metal at lower prices. That's been the story every single time the CME margin mechanism has triggered a liquidation. Stick with me here because this next part is the one that should make your jaw drop. When CME raised margin requirements from 15% to 18% on February 6, 2026, that was their 3rd margin hike since January 13th. 3 hikes in 23 days. And each hike, as Phil Strebel, chief market strategist at Blue Line Futures explained, translated to approximately a $20,000 move on a single standard 5,000-ounce contract. Now think about what that does to a leveraged futures trader who's already sitting on a position that's been swinging $15 to $20 per ounce in a single session. They get a margin call. They have to post more cash immediately or their broker closes the position. The broker doesn't ask if the fundamentals are still intact. The broker doesn't care that registered COMEX inventory has dropped 64% since 2020. The broker sees a margin shortfall and hits sell. And then the next trader gets a margin call. And the next. And the next. It's a cascade that has nothing to do with the real world and everything to do with leverage mechanics. The paper price crashed not because silver suddenly became less valuable. It crashed because a financial mechanism designed to manage risk instead created the very volatility it was supposed to contain. Here's the historical irony. COMEX raised margin requirements on silver in 1980 during the Hunt brothers squeeze for exactly the same reason, to force out leveraged longs and stop the price from rising. The market crashed. But the fundamental shortage that the Hunt brothers had correctly identified didn't go away. It just took longer to resolve. We are watching the 2026 version of that same playbook. Now let me show you the smoking gun. Because when you look at the institutional positioning data, something very specific stands out. The Silver Institute reported that total above-ground silver inventories, not just COMEX but globally, have been running a structural deficit for 4 consecutive years. Mine supply is constrained. Ore grades are declining. Most silver is produced as a byproduct of copper, zinc, and lead mining, which means primary silver production can't simply be ramped up on demand. Industrial consumption, driven by solar panels, electric vehicles, and electronics, has been absorbing silver faster than it can be mined. According to JP Morgan's own research, published in early 2026, silver prices would average $81 per ounce this year, more than double 2025's average, driven by industrial demand and what they described as tariff uncertainty, creating physical scarcity dynamics. JP Morgan. the same institution that has historically held massive short positions in COMEX silver. They are publicly forecasting $81 average silver in 2026, and we've already been above $120. Now they're forecasting the floor. Let that sink in. The paper market sold silver to $74 in February. JP Morgan says $81 is the average for the year. The paper price and the institutional forecast don't line up. Which one do you believe? Here's where it gets truly alarming. Wheaton Precious Metals just finalized a $4.3 billion silver streaming deal with BHP Group for the Antamina mine. Samsung locked up 100% of a silver mine's output in Mexico for 2 years through a direct offtake agreement, bypassing the futures market entirely. And according to the financial data reported in early March 2026, large-scale electronics and solar manufacturers are now negotiating offtake agreements directly with primary silver producers to guarantee their supply chains. These are some of the largest corporations on Earth, and they are going around the COMEX. They are not buying paper silver. They are locking up physical production years in advance. Why would Samsung and Wheaton Precious Metals be doing this? Why would companies spend billions of dollars securing silver supply outside of the exchange system if the paper price at $82 or $84 was telling them they could just buy it there whenever they need it? The answer is obvious when you look at the data. They don't trust the exchange. They see the same registered inventory numbers you're looking at right now. They see 86 million ounces of registered silver against delivery demands that are running at 60% of that inventory in a single month. And they are quietly, methodically securing their own supply before the paper market runs out of credibility. The disconnect between the paper and physical markets is becoming impossible to hide. I want you to think about this like a bathtub. The COMEX registered silver inventory is the water in the bathtub. The drain is industrial delivery demand. For years, the faucet, which represents new supply coming in, was keeping pace with the drain. As of right now, the drain is open wider than at any point in exchange history, and the faucet hasn't changed. You can see the water line dropping, from 240 million ounces in 2020 to 167 million ounces in October 2025 to 86 million ounces today. The water line is dropping fast. And what does a falling water line in the COMEX bathtub mean? It means that at some point, and the March 2026 delivery cycle is the most acute stress test yet, the exchange will have to choose between delivering real silver it may not have or settling in cash. Cash settlement would be the tell. If you're watching this in real time and you see CME Group announce cash settlement alternatives for silver contracts, they already introduced them during the January stress, by the way, that is the market sending you the clearest possible signal that the paper price is no longer connected to physical reality. Now let's make this personal. Because I can pile data on you all day, and it means nothing if you don't understand what it means for your financial situation. So let me walk through what this actually looks like from where you're sitting. First, if you're holding paper silver, SLV, silver ETFs, silver futures, you need to understand that the February crash was not a one-time anomaly. The CME has now raised margins on silver more than 6 times since late 2025. Each hike creates the same liquidation cascade. Paper silver prices can be pushed down by exchange mechanics regardless of what's happening in the physical market. If you're holding paper, you're not holding silver. You're holding a claim on silver. And the question you should be asking is, in a stress scenario, can that claim actually be fulfilled? The iShares Silver Trust, SLV, has faced what reports describe as renewed scrutiny over its ability to source physical metal during periods of extreme demand. That is a very diplomatic way of saying what I think you should be thinking about directly. Second, if you're considering physical silver, the premiums have been elevated precisely because of the dynamics we've been discussing. Dealers are paying above spot because they're sourcing in a tight physical market. That premium over spot price is itself a signal about where physical demand actually is versus what the paper market is telling you. Third, the Fed situation is crucial to understand in the right frame. Markets are pricing in 2 rate cuts in 2026, currently anticipated for June and September. Historically, when the Fed is in an easing cycle, or even anticipated to be, hard assets including silver have outperformed. The jobs data that pushed silver down on February 11th didn't change the easing trajectory, it just delayed it by a few months. The structural case for silver as a non-yielding hard asset improves as rates decline, not weakens. Fourth, watch the gold to silver ratio. Right now that ratio is somewhere between 55 and 65, depending on where you're measuring prices. Historically, when silver catches up to gold in a metals bull market, the ratio compresses dramatically. In 1980, it compressed to below 15 to 1. In 2011, it compressed to about 32 to 1. If the ratio moves from 60 back toward 40, silver would be at dramatically higher prices even if gold holds flat. JP Morgan's own research noted that when the gold to silver ratio breaks down, silver tends to perform better than gold, and described that as a signal of a possible leadership change in the precious metal space. Fifth, pay attention to the Shanghai premium. I mentioned the 12% spread. If that spread widens further, above 15–20%, it means the arbitrage mechanism that historically kept global silver prices aligned is breaking down even more severely. A widening Shanghai premium with declining COMEX inventory is a combination that has historically preceded price dislocations in the paper market. Sixth, watch what the large industrial users do. When Samsung and Tesla and the major solar panel manufacturers are bypassing the futures market to lock up direct supply contracts, they are telling you with their capital allocation what they believe about future silver availability. Corporate procurement managers who spend their careers analyzing supply chains don't spend billions of dollars on direct offtake deals unless they believe the alternative, buying from the exchange when you need it, carries unacceptable supply risk. Seventh, be cautious of the narrative that margin hikes equal, quote, smart money selling silver. That is backwards. Margin hikes force liquidation of leveraged paper positions. The same metal that gets sold in a paper market cascade is being bought and physically removed from COMEX vaults by industrial users and institutional holders at exactly the same time. The data shows this plainly. Registered inventory has been declining even during the periods of paper price weakness. Someone is buying the metal even when the paper price is falling. They are not the same people hitting the sell button on futures screens. I want to be absolutely clear. None of this is financial advice. I'm not a financial advisor, and nothing I've said here should be taken as a recommendation to buy, sell, or hold any investment. What I'm doing is presenting you with the documented data so you can make your own informed decisions. Always consult a qualified financial professional before making investment choices. Let me bring this full circle because I want to make sure the complete picture is locked in your mind. We started with a number, $84.20. Silver today, March 6th, 2026. You now know that this price represents a recovery from a CME engineered paper market crash, the third in a series of margin hikes that pushed the price from $121.62 down to the mid-70s in the span of days. You know that this crash had essentially nothing to do with physical silver supply and demand, and everything to do with the leverage mechanics of a futures exchange. You know that while the paper price was being manipulated lower by margin calls, COMEX registered inventory continued to drain, sitting at 86.1 million ounces against March delivery demands of 52.63 million ounces. You know that in January, 26% of registered COMEX silver inventory was physically withdrawn in 2 weeks, 7 to 10 times the historical norm. You know that China closed its silver export valve on January 1st, 2026, creating a 12% Shanghai premium that signals the global silver market is no longer functioning as an integrated whole. You know that Samsung, Wheaton Precious Metals, and major industrial users are spending billions of dollars to secure physical silver outside the exchange system, which is the loudest possible signal that they don't trust the paper price to reflect physical availability. You know that the Federal Reserve remains in an anticipated easing posture, with 2 rate cuts priced in for 2026, and that serious institutional money, from David Einhorn to JP Morgan, is building hard asset exposure around that expectation. The people who didn't understand this history in 1980 watched silver run to $50 and then got crushed when the COMEX changed the rules. The people who didn't understand this in 2021 bought the Reddit squeeze at the top and sold at the bottom when the paper market pushed it back. But look at what happened to COMEX inventory from 2021 to now. It dropped from over 200 million ounces to 86 million. The squeeze attempts failed in the paper market but bled the inventory continuously. Each paper battle left the physical vault a little emptier. And here we are in March 2026, with the inventory at its lowest level since records have been meaningfully tracked, delivery demand running at historically unprecedented rates, industrial users scrambling to lock up supply years in advance, and China's supply chain now off the table for emergency arbitrage. The signs are not subtle. They are in the public COMEX delivery reports. They are in the CME's own margin notices. They are in Samsung's mining contracts and Wheaton's billion-dollar deals. They are in the Federal Reserve's 2-to-1 dissent on holding rates. The question, as it always is not whether the data is there. It's whether you see it before it becomes obvious to everyone. Silver at $84.20 today, 30% below its all-time high reached just 5 weeks ago. COMEX inventory at its lowest level in modern exchange history. March delivery demand at the highest ratio to available inventory ever recorded. China's export controls effectively shutting the arbitrage valve. The Fed in an anticipated easing cycle. Industrial users locking up physical supply and multi-year direct deals. And a paper market that has now been hit with more than 6 margin hikes in 4 months, each one engineering a temporary price collapse that changes nothing about the physical supply-demand reality. That is the complete picture. You now have the numbers. You now have the historical context. You now understand why the paper price and the physical reality are telling different stories. What you do with that information is entirely up to you, but at least now you're working with the whole picture, not just the headline that the financial media hands you. Drop a comment and tell me, are you watching the registered COMEX inventory numbers daily at this point? Or is this the first time you've looked at these delivery figures? I read every single comment. Your perspective on how you're processing this data, whether you're a physical holder, an ETF holder, someone on the sidelines, or someone who just learned what a COMEX delivery notice is today, that tells me what to cover next. Because the March delivery cycle is not over. We're watching it in real time, and I'll be here breaking down every meaningful data point as it comes in. If you want to make sure you don't miss those updates, subscribe. You've just spent 24 minutes understanding something that took me years of tracking data to piece together. Don't let the next margin hike catch you off guard. This script is for educational and entertainment purposes only. Nothing in this video constitutes financial advice. Always do your own research and consult a qualified financial professional before making any investment decisions. All data cited is sourced from public records including COMEX delivery reports, CME group filings, Federal Reserve statements, and verified financial news sources.